Imagine this. You're standing at the crossroads of two very different paths. To your left, a conventional road, well-trodden, familiar, and seemingly safe, where the traditional investing rules are written in stone. On this road, you follow the advice that has been passed down for generations. Diversify, stay passive, and pray that your investments outlast the market's inevitable volatility. And yes, while this approach has certainly worked for some, it also leaves many investors struggling to keep up with the market's highs and lows, risking long-term wealth for short-term peace of mind. But to your right, there's another road, one that's bolder, more strategic, and often overlooked. This is the path of the muscular portfolio. It's a way of investing that is more agile, more dynamic, and more attuned to the changing rhythms of the financial world. This is the investment strategy that the majority of mainstream investors ignore, yet it holds the potential to deliver superior returns with significantly lower risk. Now, you might be wondering, isn't this just another high-risk, high-reward scheme that promises the moon but delivers disappointment? Well, that's where Brian Livingston's Muscular Portfolios, the investing revolution for superior returns with lower risk, comes in. This isn't about reckless speculation or chasing fleeting trends. Instead, it's about reshaping the way you think about your investments, from a passive, hands-off approach to an active, disciplined, and ultimately more powerful one. It's about turning the conventional wisdom on its head and building portfolios that don't just weather the storms of the market, but come out stronger, more resilient, and more profitable than ever before. Livingston's approach is grounded in a few key principles that go beyond typical investment theory. He introduces readers to the concept of muscular portfolios, which leverage dynamic strategies and robust asset allocation techniques to maximize returns while simultaneously managing risk in a way that is both innovative and pragmatic. By challenging the status quo, Livingston offers a refreshing perspective on how anyone, from the novice investor to the seasoned professional, can approach the markets with greater confidence and foresight. Picture a portfolio that grows not just in bull markets, but also holds steady during bear markets. Imagine an investment strategy that adapts to the changing financial landscape, rising and falling in tune with it, rather than being buffeted by its whims. This is what a muscular portfolio can offer, a blend of strength, flexibility, and strategy that helps you maximize your returns while safeguarding your hard-earned wealth. At the heart of muscular portfolios is the understanding that long-term success in investing doesn't come from blindly following trends or hoping that the market will work in your favor. Rather, it comes from carefully constructing a portfolio that is designed to not just endure the market's ups and downs, but to capitalize on them. Livingston's approach encourages you to think of your investments as a living, breathing entity, one that needs nurturing, attention, and most importantly, a well-thought-out plan. In the following pages, Livingston walks you through a revolutionary new framework for investing, one that empowers you to take control of your financial destiny. With a focus on asset allocation, diversification, and market timing, he lays the foundation for building a portfolio that is as strong as it is smart. Whether you're just starting out on your investment journey or looking to refine your existing strategy, this book provides a clear, actionable path to success. What makes Muscular Portfolios particularly compelling is that it doesn't just focus on the mechanics of investing, it also challenges the very mindset that governs the way most people approach the markets. Livingston encourages readers to rethink everything they thought they knew about risk and return. He unveils the often hidden strategies used by some of the world's most successful investors and shows you how to incorporate these methods into your own portfolio, regardless of your starting point. This book is for anyone who has ever felt overwhelmed by the complexity of investing, unsure of which strategies are worth pursuing and which are destined to fail. It's for those who understand that achieving superior returns is not about guessing the next hot stock, but about constructing a portfolio that is built for long-term growth. Livingston's insights are not just for the wealthy elite. They are for anyone who wants to take control of their financial future and make smarter, more informed decisions with their money. So, if you're tired of the conventional investing advice that leaves you wondering if there's a better way, If you're ready to explore a more powerful, proactive approach to your financial strategy, then you're in the right place. Muscular Portfolios is not just another book on investing, it's a revolution in the way we think about managing our money. And it all begins with the realization that, in today's unpredictable market, strength and flexibility aren't just advantages, they're essentials. Part 1. The Muscular Approach, Revolutionizing Traditional Investing. In the opening section of Muscular Portfolios, Brian Livingston wastes no time shaking up conventional wisdom about investing. Traditionally, investors have been taught that the key to success is diversifying their holdings, spreading risk across as many different types of assets as possible. This diversification model has been widely accepted and promoted by financial experts for decades. However, Livingston takes a bold stance, arguing that traditional diversification is not the best strategy for maximizing returns while keeping risks manageable. Instead, he proposes a new, more concentrated approach to building wealth, what he calls a muscular portfolio. What makes a portfolio muscular? Livingston defines a muscular portfolio as one that is specifically designed to achieve superior returns with lower risk by focusing on a select number of high-performing assets. Rather than spreading investments across a broad range of stocks, bonds, and other assets in an effort to minimize risk, a muscular portfolio focuses on a more concentrated approach. Livingston emphasizes that concentration doesn't mean being reckless. It's about identifying and owning a handful of the most robust, resilient investments that have the highest potential for growth. This idea runs counter to traditional investment strategies that advise diversifying across dozens, if not hundreds, of different assets to protect against any one investment's poor performance. For Livingston, the emphasis is not on avoiding risk, but on strategically managing it. A muscular portfolio reduces risk by choosing a concentrated group of assets that have already demonstrated strong performance and are likely to continue on that trajectory. The case against over-diversification. Livingston dives into a critique of the traditional investment advice of over-diversification, something that has been ingrained in financial thinking for generations. He explains that while diversification does indeed lower the risk of a portfolio by spreading investments across various asset classes, it also dilutes the potential returns. The core problem with this approach, according to Livingston, is that by diversifying too widely, an investor limits their chances of achieving superior returns because they spread their capital too thinly. This is where the muscular approach differs. Rather than investing in a broad range of asset classes or individual stocks to minimize the possibility of loss, the muscular strategy seeks to make fewer, more powerful investments that are more likely to succeed. By focusing on the highest quality assets, those with a strong track record, proven growth potential, and a high likelihood of continuing to thrive, investors can achieve much higher returns without taking on disproportionate risk. The myth of safety in traditional diversification. Livingston also challenges the prevailing belief that traditional diversification offers safety. He points out that diversification does not guarantee stability or protection during market downturns. In fact, a heavily diversified portfolio can suffer just as much as a concentrated one when the markets crash, especially when a large number of the assets within it are closely correlated or part of the same market sector. For example, during a financial crisis, stocks from various sectors or bonds from different governments may all decline simultaneously. In such cases, diversification can offer little protection from massive losses. This, Livingston argues, is an area where the muscular portfolio strategy can truly shine. By focusing on a select number of investments with low correlations to one another and high growth potential, investors are able to navigate volatility more effectively while reducing the risk of catastrophic losses. Key elements of a muscular portfolio. Livingston identifies several key components that make up a muscular portfolio, each of which contributes to its ability to provide superior returns with lower risk. 1. Focus on quality, not quantity. In a muscular portfolio, the focus is on a few high-quality assets rather than a vast array of holdings. This requires extensive research and a keen understanding of which assets have the best chance of success in the long term. 2. Strategic risk management. Muscular portfolios do not shy away from risk. Rather, they approach it strategically. Livingston discusses how to assess risk in a way that allows for high returns without jeopardizing overall stability. This involves not just analyzing market trends, but also looking at factors like company fundamentals, leadership, and industry outlook. 3. High-conviction positions. The key to a muscular portfolio is investing in assets you believe in wholeheartedly. It's about taking high-conviction positions rather than dabbling in investments that are based on trend following or speculation. This means spending time identifying the companies or sectors that are likely to outperform and holding these investments with confidence. 4. Efficient asset allocation. Livingston explains that a muscular portfolio does not waste resources on too many different asset types. It is more efficient in terms of capital allocation, ensuring that every dollar invested is being put into an asset with strong growth potential. He suggests that having a portfolio of 8 to 15 well-chosen investments is far more effective than holding 50 or more positions that dilute the impact of each individual asset. 5. Adapting to changing conditions. Another core component of a muscular portfolio is adaptability. Livingston argues that the financial markets are dynamic and ever-changing, and a successful investor must be able to recognize when to adjust their strategy. A muscular portfolio is not static. It evolves based on market conditions, emerging trends, and new opportunities. 6. Long-term vision. A muscular portfolio isn't about short-term gains or speculation. It's designed with a long-term perspective, with an emphasis on holding investments through market cycles and economic fluctuations. This long-term mindset is crucial for weathering volatility and maximizing the potential of carefully selected investments. Building a muscular portfolio. Practical steps. In this section, Livingston transitions from theory to practice, providing readers with concrete steps they can take to build their own muscular portfolio. He emphasizes that creating such a portfolio requires a blend of research, discipline, and patience. 1. Assessing risk tolerance. The first step in building a muscular portfolio is understanding your own risk tolerance. Livingston guides readers through the process of determining how much risk they are willing to take on, based on factors like their investment goals, time horizon, and financial situation. 2. Identifying high-quality assets. Once risk tolerance is established, the next step is to focus on finding high-quality assets. Livingston suggests looking for companies or investments with strong fundamentals, those that have proven business models, a track record of success, and a clear growth trajectory. 3. Concentrating investments in the best opportunities. Instead of spreading investments across many different asset classes, a muscular portfolio encourages concentration in the best opportunities. Livingston discusses how to assess which assets have the highest potential and recommends focusing on those that align with your financial goals. 4. Diversification, but in a strategic manner. While Livingston advocates for a concentrated approach, he does not completely reject diversification. Instead, he recommends diversifying within the portfolio in a strategic way, ensuring that the selected assets are not too closely correlated with one another, which could increase the risk of significant losses during market downturns. 5. Monitoring and adjusting the portfolio. Finally, Livingston stresses the importance of ongoing monitoring and adjustments. A muscular portfolio is a living, breathing entity that should be reassessed periodically. As market conditions change and new opportunities arise, the portfolio should evolve to remain aligned with the investor's goals and risk tolerance. Part 2. Building the foundation of a muscular portfolio. In Part 2, Brian Livingston builds on the foundations laid in the first section and begins to explore the practical tools and strategies necessary to implement a muscular portfolio. This part provides readers with a roadmap to successfully apply the principles of a muscular portfolio in the real world, ensuring that it's not just theoretical but actionable. He moves from concept to execution and provides a clear path for how investors can begin creating their own high-performing portfolios. The power of high-conviction investing. One of the central ideas Livingston introduces in this section is the power of high-conviction investing. In a muscular portfolio, it's not about guessing or predicting market movements, but about making informed decisions on a select number of investments that you believe will perform exceptionally well in the long term. This idea takes a departure from traditional investment approaches, which often focus on spreading investments across various sectors, industries, and asset classes. Livingston emphasizes that true success in investing comes when you build high-conviction positions in a few, carefully researched companies or assets. These are the investments you feel confident about because they have proven track records, solid fundamentals, and a clear path to future growth. He stresses that high-conviction investing doesn't mean taking blind risks, but rather making calculated, thoughtful decisions that align with your own understanding of the market. For example, if an investor believes in the long-term potential of a specific technology company, they could build a significant position in that company, focusing on its prospects over the next 5 to 10 years, rather than diversifying their investments into 50 or more companies across different sectors. In this way, they are not simply following the crowd, but are making investments in the best opportunities they believe in. The role of concentration in muscular portfolios. As Livingston moves deeper into the philosophy of muscular portfolios, he addresses the role of concentration. Many investors are familiar with the term diversification, but the concept of concentration is less commonly discussed. In Part 2, Livingston makes the case that concentration is essential for maximizing returns in a muscular portfolio. While traditional investment strategies advocate for holding a broad range of assets to reduce risk, Livingston argues that a concentrated portfolio of high-conviction positions can deliver far superior returns. He lays out the concept of the 20/80th principle, where 20% of your investments generate 80% of the returns. By focusing on the highest potential assets and concentrating your investments in these, you allow them to have a much larger impact on your portfolio's overall performance. This concentrated approach means taking a more active role in managing your investments, rather than passively relying on a vast, diversified portfolio. However, Livingston does not advocate for reckless concentration. He is quick to stress that concentration should only be pursued after extensive research and analysis. The assets that make up your portfolio should be selected based on solid criteria that you believe will ensure their continued success. These assets should also be highly resilient to external shocks, which is why quality over quantity is a cornerstone of the muscular portfolio. Strategic risk management. Managing downside without compromising upside. A key tenet of a muscular portfolio is managing risk effectively without sacrificing potential returns. In Part 2, Livingston dives deep into how to manage risk strategically. Many investors view risk as something to be avoided, but Livingston flips that idea on its head. Risk is an inherent part of investing, and the goal is not to avoid it, but to control it. By embracing risk strategically, investors can position themselves to achieve greater upside without opening themselves up to catastrophic losses. One of the most important risk management tools in a muscular portfolio is position sizing, how much money you invest in each asset. Livingston introduces the concept of adjusting position sizes based on the level of conviction you have in each investment. For example, if you have a particularly high level of confidence in a specific stock or asset, you may decide to allocate a larger portion of your portfolio to it. On the other hand, for assets that are less certain, you may choose to allocate a smaller portion. This strategic approach to position sizing ensures that you are not overexposed to any single asset, while also allowing your high-conviction positions to have a significant impact on your portfolio's overall returns. Livingston emphasizes that the goal is to balance risk and reward, making sure that you can weather potential downturns while maximizing your returns from the assets that perform the best. The role of research and analysis. Livingston stresses the importance of in-depth research and analysis when constructing a muscular portfolio. He outlines a step-by-step guide to evaluating potential investments and how to apply a fundamental analysis framework to assess the health and potential of companies or assets. This research process begins by assessing the financial health of a company, including key metrics such as revenue growth, profitability, debt levels, and cash flow. Livingston advises investors to avoid companies with significant debt or poor cash flow, as these factors can undermine long-term growth potential. Instead, he recommends focusing on companies that demonstrate strong financials and a history of steady growth. Additionally, Livingston introduces a more qualitative approach to analysis, encouraging investors to consider the management team, market position, and competitive advantages of companies they are interested in. A strong, visionary leadership team can make all the difference in navigating market volatility, so it's important to assess the people behind a company's success. Lastly, Livingston discusses the importance of understanding market trends and macroeconomic conditions. By staying informed on broader market movements, investors can better anticipate how individual assets might perform in the context of larger economic shifts. Asset selection criteria. A major portion of Part 2 is dedicated to Livingston's criteria for asset selection. He offers readers a comprehensive guide for determining which assets belong in a muscular portfolio. The selection criteria are rigorous, ensuring that only the highest quality investments make the cut. Livingston identifies several key factors to consider when selecting assets for your portfolio. 1. Strong fundamentals. As mentioned earlier, the foundation of any good investment is strong financial health. Companies with a consistent record of profitability, high revenue growth, and low debt are ideal candidates for a muscular portfolio. These companies are not only more likely to weather economic storms, but are also more likely to deliver consistent returns over time. 2. Competitive moats. A company's competitive advantages, what Livingston calls its moat, are crucial to its long-term success. Companies with strong competitive moats, such as unique technologies, brand loyalty, or market dominance, are better positioned to fend off competitors and maintain profitability. These types of companies should be prioritized when building a muscular portfolio. 3. Growth potential. The best investments are those that have a clear and achievable path to growth. Livingston advises investors to seek out companies in industries with strong growth potential, such as technology, renewable energy, and emerging markets. These companies are more likely to deliver above-average returns and provide investors with the upside they seek. 4. Resilience to market downturns. While no asset is completely immune to market downturns, companies with strong balance sheets, consistent cash flow, and a proven track record of navigating economic challenges are more likely to survive and thrive during tough times. These companies should form the core of a muscular portfolio. 5. Management quality. Finally, Livingston stresses the importance of the people running the company. A capable and visionary management team can drive a company's success, while poor leadership can lead to stagnation or failure. Investors should always evaluate the track record and vision of a company's leadership before making an investment decision. Practical steps for building your muscular portfolio. As Part 2 concludes, Livingston provides readers with a clear set of steps to begin building their own muscular portfolio. The process begins with evaluating personal investment goals and risk tolerance, then moves on to researching potential assets using the criteria he outlines. Livingston also emphasizes the importance of patience and discipline in building a muscular portfolio. Unlike traditional investing strategies that focus on frequent buying and selling to capitalize on short-term market movements, the muscular portfolio approach is long-term in nature. It requires confidence in your high-conviction investments and a commitment to letting them grow over time. Final reflections. In his closing remarks, Brian Livingston reflects on the journey of building and managing a muscular portfolio. He reminds readers that while the strategy requires careful thought, patience, and discipline, the payoff can be profound. By investing in fewer, higher conviction assets and staying committed to a long-term vision, investors can unlock superior returns without exposing themselves to excessive risk. Livingston also encourages readers to continue learning and evolving as investors. Markets are always changing, and the investor who remains flexible, informed, and open to new opportunities will be better positioned to succeed. He concludes with a message of empowerment, reminding readers that they have the tools, strategies, and knowledge to create a muscular portfolio that aligns with their goals, preferences, and risk tolerance. With the right mindset, discipline, and approach, anyone can harness the power of a muscular portfolio to achieve financial success. Thanks for listening. Please like, subscribe, and click the bell icon to get new video updates. Happy learning!